Can anybody hear me? Guys, I'm going to start this at 9:30. Can everybody hear me? Can anybody not hear me? Seems like I can hear some noises. Can anybody hear me?
Hello?
Yeah,
Hi.
I can hear you.
I see Tina.
How's it going?
Hi, Omar. I got you. I see you. Can you hear me?
Yep. Okay.
Awesome. I'm not sure how many people are going to join us because, you know, with this COVID thing going on, there could be people that they might have situations with their family or they might even be sick. I don't know, but you know, whoever can join, that's great. I plan on doing this basically like our normal class meetings till the semester ends. So hopefully that'll help. We got a couple more chapters to get to. I remember before the break when I said if something happens, you know, you guys know what to do. I didn't realize we would be out for the rest of the semester. It's kind of crazy. All right, so it looks like we got 4. So first thing I want to ask, I have the, I'm doing this, it's called a share screen. I'm sharing my screen right now. And can you guys see the chapter 10 PowerPoint where it says performance evaluation?
Yep.
Everybody can see that? I guess if you can't see it, let me know. One thing I want to show you, I'm going to change something real quick here. Give me a second. Oh, there it is. All right, can you guys see the Blackboard screen?
Yeah.
Okay, just real quick. About your exams, I went in and I looked at your tests. Overall, I thought they were pretty good. I normally don't do this, but I ended up giving you a 12-point adjustment on the exam. So whatever your initial scores were in my accounting lab, like for example, let's say you had a 70% on the test, just add 12 to that and you would have had an 82. If you had an 88, then you would have 100. So I normally don't do that, but you know, we've been offline for a couple weeks, and I finally got this Zoom thing to work. I think it's pretty cool, so we're gonna try it. But that's one thing I just want to kind of make attention to you. The other thing, I do plan on doing this weekly. So every Tuesday, Thursday, I'll send out the same announcement. It's the same link to get in here. You don't have to type in a password. It should be the same setup once you've done it once. And we'll just kind of go from there. Now on the revised schedule, as you're following it, this week is chapter 10. And then the next couple of weeks, I'm going to work with you on chapter 11. There's some things I want to show you on how to do standard cost calculations. But this chapter, just to kind of give you a heads up, this week, this chapter is actually, I think you'll probably find pretty easy. Next to the chapter 9, which is on budgets, this chapter, we're going to look at a couple performance measures on how you evaluate segments. And there's one budget in particular, it's called the flexible budget. And I want to show you how you create that and how you evaluate it, and how you also compare it to the actual results. And so we'll kind of do that today. Today, my plan is to try to walk you through some of the performance measures. It's called ROI, capital turnover, sales margin. You're going to probably feel like this is a little bit like financial accounting because these are, in essence, kind of like ratios. So I don't think you'll have any problem with that. You just have to follow the formula. But we'll see how it goes. I did this yesterday for the first time with one of my other classes, and it went okay. I had a couple issues where my screen locked up on me, so bear with me if something happens. I'll try to get it back. Hopefully, I've been trying to work on some of the controls. They don't seem to kind of show up on my computer like they showed me on the training, and that's just something I'll kind of have to work out. So looks like we got one more person kind of logging in now. So let me go back. I'm going to get back to that couple of things I want to talk about first on the PowerPoint. Oh, last thing, I almost forgot. I went ahead, let me click this. So guys, if you go into your learning modules, I'm going to click that. And so for example, we're in chapter 10 now. I went ahead, if you look at this, you see where it says chapter 10 narrated lecture video. Note that everything now is in MP4 format. I actually went back and I reformatted all of my files. So it should be easier for everybody to view all my illustrations. Before, they were just saved as a PowerPoint mix, which you had to have the actual PowerPoint to view it. This time, with an MP4 format, it shouldn't matter what computer you're on. You should all be able to play all of these videos. So what I have here is the lecture video. So I'm not going to go over the whole PowerPoint, but you can go through that on your time. I've got some good textbook illustrations, and I've got all the homework illustrations narrated for you as well. But I just want to make a note that that is in MP4 format. So it should be easier for you guys to view those. So I'm just going to make a note of that. And again, that's going to be the same for all of the rest of the chapters. We're just going to be doing chapters 10 and 11. I just shortened it. So you'll find the same thing in chapter 11. So I just want to make you aware of that. All right, so let me go in. All right, so everybody got this? It's the actual PowerPoint?
Mm-hmm.
Okay, cool. So again, this chapter, it's about performance evaluation. And I usually talk about this concept, like if we were in the face-to-face setting, I would kind of mention a couple things about the concept of decentralization. I actually worked in industry at a company where all of the accounting was actually decentralized, which was actually kind of cool because at my end, I was a cost manager and I did some of this stuff, and it kind of made you feel like you're actually contributing and making decisions for the company. Whereas sometimes if you're just in like a corporate setting, it's real easy just to kind of, be just a part-time player. You're a piece to the puzzle, and you don't really actually get to make decisions. But I actually did some of the stuff where you're actually evaluating segments, you're looking at cost issues, you're trying to save the company money. But you can read through that. There's pros and cons to decentralization, and a lot of companies do it. But obviously, one of the big disadvantages, if you look at the bottom, is where it says potential problems for goal congruence. I saw a lot of that. I saw there was a lot of political problems, a lot of fights. People trying to move up the corporate ladder. Sometimes they wanted to get their bonuses, and sometimes that didn't really match what the company was actually trying to achieve. And I saw a lot of stuff. But again, I'm not going to talk about all that today. But you can read through that. But I want to get down to, there's what they call types of responsibility centers. You have what they call cost centers, revenue centers, profit centers, investment centers. And it is what it is. I mean, if you're looking at cost centers, you're trying to look at actual cost versus budgeted cost. Same thing with revenue. If you're looking at revenue centers, you're trying to figure out, how much money did you make versus how much do you think you should be making? And they all kind of work the same way. And when we get to the flexible budgets, I'll take you line item by line on them on how to do those evaluations. Okay. So here's one example where they're showing you a partial performance of a revenue center. And let me enlarge this. Hold on. All right. So if you can see that, notice how they've got, I'm going to change to my stylus here. I kind of like this tool I've got. So you can see right here, you've got a column that says actual sales. And notice this particular example is chips. And so they're comparing, this is Midwest sales region. They got the actual sales. And notice here is your budgeted sales. And all they're doing is they're saying, for example, if you had Sun Chips, and they'll just kind of use this example, 2,367,000 versus a budgeted sale of 2,400,000. All they did was took the difference and said that's a variance of 32,800, and they said that that's unfavorable. And obviously, because you want your actual sales to be more than your budgeted sales, that's the idea. And so this is just one aspect of this chapter when you're doing some comparisons. This one's pretty simple because you know it's revenue, it's sales, and you're just comparing essentially your actual sales, which is everything. I'm going to change it. Everything in this column versus everything in your budget. Now, this particular budget, this column, as you kind of go through your study this week and you're reviewing this stuff, they often refer to this as your master budget. And that's essentially the same as chapter 9. The budget that you looked at in chapter 9 when you did that sales budget, that's where this would have come from. Okay, so just to kind of build on each chapter. Okay, all right, so we got that. Let me get back to my mouse. All right, so, all right, and I'm going to change something real quick. Hold on just a second. All right, it's easier for me to kind of scroll down this way. All right, so what I want to get to, oh, and here's one more slide. I'll just kind of bring this to your attention as well. I'll just leave it in this format. But if you notice, this particular example, if you review it, this is on a complete segment margin. So you'll notice that they're actually looking at the operating income. And so what they did is they compared the actual results. This is exactly what you would have gotten from your ledger. And then here's your master budget. And then they just go line by line. They compare the actual to the budget, and they come up with a variance. And so, for example, here's your sales revenue, 4,314 versus 4,300. Notice the difference is positive, it's favorable, because you had more. Now, remember, this is going to flip when you look at your cost. So, for example, if your cost of goods sold is 1,728 and your budgeted cost of goods sold is 1,720, of course, you'd want your actual cost to be lower than your budgeted cost, because that means that your lower cost is what you're trying to achieve. You'd say good, but in this case, because your cost of goods sold was higher than the budget, the difference is obviously they're going to say that's unfavorable. But these are pretty simple as you just kind of review them. There's no trick to it. There's actually none. You're just comparing actuals to the budgets. That's all you're doing. That's why this chapter is called performance evaluation. You didn't really do that in chapter 9. In chapter 9, you simply just were working on preparing the budget. In this chapter, it's more about comparing actuals to that budget. Okay, so what I want to show you now, let me clear these drawings, is a couple of calculations. These are kind of like ratios. It's called ROI, sales margin, and capital turnover. All right, so ROI, sales margin, and capital turnover. And I'm going to get to the slide. So these are just formulas, and you can go back and write these down, take notes on this, memorize it. But your ROI, this is one way to calculate it. It's all you do is you take your operating income and divide by your total assets. And it's called ROI. It's called return on investment. So I'm just going to make a note of it. So ROI is operating income divided by total assets. Now, what that's essentially trying to tell you is just think about the logic here. A company has assets to produce money, right? To make money. So when you're comparing operating income, just like a ratio, to the total assets, you're basically saying these total assets are generating how much operating income, okay? And they call this your return. So clearly, of course, you'd want to have higher income versus total assets. That means that your assets are producing a lot of money. So ROI is one calculation we're going to do. And then eventually what we'll do with that is we'll possibly compare that to some sort of target. And that target will be whether it's 10% or 20%. And that's how we're going to do our evaluation to say if our ROI is any good. Now, let me show you something. So you got operating income divided by total assets is your ROI. the other two calculations, you've got what's called sales margin and capital turnover. But do you see this thing right here? Let me kind of highlight this in this PowerPoint. So you'll notice that this right here, and I've already kind of, oh, let me clear this. Okay, so sales margin is this calculation right here. All right, sales margin, oh, I got to change the setting here. Hold on just a second. All right, so sales margin is when you take operating income and divide by sales. That's another type of calculation. And then you've got capital turnover, which is sales divided by total assets. So these are two individual calculations you'll have to do. When you do your My Accounting Lab homework, you might get a problem that says calculate sales margin. It might say calculate capital turnover, and then they might also say calculate ROI. But I want to show you, since I got this PowerPoint up, so if you do sales margin is kind of like your profit margin. You're taking your basically what you're making compared to your sales, operating income over sales. Capital turnover is how much revenue, not profit, but how much revenue is generated from your assets. But I want you to look at this. If we take the sales margin and multiply that by the capital turnover, guys, look at what cancels out. Do you see how the sales cancel out? And at the end, you get operating income divided by total assets, which is essentially how you calculate ROI. So sometimes they call that, I think they call it like the advanced formula or some sort of weird formula. It is what they want to call it. Just make sure you know how to calculate it both ways. You may have to do that, I believe, in your My Accounting Lab homework and possibly in the quiz as well. Okay. And so there's a couple different ways to calculate that. So again, I'll go back. So you've got just your basic, the simple way to do it in a problem, if they give you operating income and total assets, you just divide, and that'll be your ROI. And if they don't give you that, then they might give you a couple of these others, and they may say calculate it using the advanced or the formula, which what they mean by that is they want you to take sales margin times capital turnover. And then finally, the other reason you want to know that is just in case it might pop up on a quiz or an exam question. You want to know that the relationship between sales margin and capital turnover and how that also gives you ROI. So let's look at this example. Let me clear this. So this is kind of like what's in your book as well. This is 10.6. This is on the PowerPoint. I think the one in your textbook, because this is an older edition PowerPoint, it might be the same problem, but they might have changed the numbers. But let's check this one out. This is 10.6, and we'll just leave this on the PowerPoint. You'll notice that a lot of the information that they give us in this chapter, most of it has already been summarized for you. So for example, what I mean by that is in this problem, see how you've got functional ingredients, consumer markets, and performance materials. They've already given you operating income, total assets, and then there's your sales revenue, okay? And so it says, this is essentially the requirements. For each of the three divisions, calculate sales margin, calculate capital turnover, and then calculate return on investment, okay? So if we start with the first one, and I'll just kind of leave this one up, and if we start with just the sales margin, so let's say we wanted to say, what is our sales margin? And if you forgot, sales margin is your operating income divide by your sales. That's how you do that. So operating income over sales. And let's just, to keep it simple, let's just do functional, all right? Notice they've given you operating income of 5,720, so that would be your numerator. And then you're going to divide that by your sales revenue, which is 22,000. Okay. So if you do that, I believe you get right around 26%. That's called your sales margin. Now, if you were to do the capital turnover, just to kind of demonstrate here, all right, so your capital turnover is your what? Your sales divided by your assets, your total assets. So if this is functional, your sales is what, 22,000? So notice that would be your numerator now. Divide that by your assets of 10,000. And I believe that's right around what, 2.2, I believe. So that would be what's called your capital turnover, which is essentially how much revenue is being generated from your assets. Your assets are turning it over about 2.2. And then the last one, if they said calculate ROI, you could do a couple different ways. You could just do operating income. All right, and divide that by your total assets. So in this case, your operating income was what, 5,720. And then your assets are what, 10,000. And so in that case, I believe it gives you right around, I have it on the next slide. I didn't do this calculation. Hold on, let me see. I think it's right around 57.2. It's a weird number. All right. It's right around 57.2%. Let me write that out just to show you. So about 57.2%. Okay. Now, the question might, because these are pretty simple calculations. So the question might be, so what do we do with that? So most of the time, what's going to happen is every company is going to have some sort of target, some sort of minimum return that they want, some sort of target return. And so eventually what you would be doing is just like you would do in financial accounting, like with the ratio, is you would compare, for example, if our ROI is 57.2%, which is actually a pretty good return. If you think about it, if they've got 5,720 divided by 10,000, that's a pretty high return. The company might have a target ROI of 10% or 12% or whatever. That's something that would be done internally. And then you'd simply be comparing this to that, whatever that target is. And then of course you do your evaluation at that point. Okay, so just to kind of make a note, these are pretty simple calculations, which I believe all of you will get these pretty easily when you do your homeworks. It's just that, you know, how do you evaluate it and what are you going to do with it? That's the thinking part of it, which again isn't difficult, but you need to know that these are numbers just in itself. You got to have something to compare these to. Okay. Now, the other thing is just to kind of make a note. So remember going back, we said that if you took, I'll clear this. If you took sales margin times capital turnover, you should also get ROI. So if you go back to this, and of course I just erased that, but let me kind of put it back up. So for example, I'll go to the next slide because it's got the answer. So do you see on this one, I'll just kind of demonstrate on this slide since we got it up. Do you see where it says, this is, again, I'm just looking at functional only, just doing this one. So the sales margin was 26% and the capital turnover was 2.2. Well, guys, if you take 26% and multiply that by 2.2, you should also come up with that 57.2. Okay, so you can do that manually later. You can go back and review this, but that's just to show you that, you know, sales margin times capital turnover is another way to calculate your ROI. Okay, now, so if I go back, all right, so I trust that, I mean, just me showing you that one, I trust that you can all take this PowerPoint, because, you know, I already have this recorded for you in Blackboard, and you can practice this. You can practice these calculations. You've got the answers right here. I'd rather you just kind of do that later. Do it a couple times, take some notes on it. I don't believe you'll have any problems with it. It's actually pretty straightforward calculation. Okay. All right, now, so you've got those three, you know, you need to know. And then another one, which is called residual income. All right. So residual income, again, it kind of is what it is. It's what you're assessing in terms of your actual income, comparing it to some sort of management expectation. So what I want you to look at is this bottom part right here. Do you notice how it says operating income minus some sort of minimal acceptable income? Well, guys, that's got to be given to you in the problem. That's going to be something that's determined at a company or at the management level. So do you see this thing where it says target rate? Target rate will be some sort of percent, like 10% or 12% or whatever. you're going to multiply that by their assets. That number times the asset is going to be your minimum target. And then you simply compare what your actual income is to that. And of course, if you have anything left over, that's going to be called your residual income. So on the next slide, let's bring this up. So notice, this is another example, Sunburst Sports Company. They like the sports stuff here. So let me change this. So on this one, it says at the bottom, I'm just going to go right to the bottom, then we'll go back and look at the numbers. But it says, refer to the Sunburst Sports data set, which is right here. This is the data set right there. It says compute each division's residual income. All right. So before we do that, we got two different divisions here. You've got, looks like you've got snow sports and non-snow sports. So they've given you sales, operating income, total assets, and current liabilities. Well, guys, we're not going to need the current liabilities, but they're giving you a bunch of stuff. Just to remember, we've talked a lot in class. Sometimes they'll give you extra information. So don't panic if they give you a bunch of stuff. But current liabilities shouldn't scare anybody. You guys had that in financial accounting. But do you also notice at the bottom here where it says Sunburst Management has a specified target of 13% rate of return? So here's the number. Somehow they've generated that as their minimum return. So if we were going to do this for the snow sports, let's just do one of them. And we want to calculate the residual income. We know that the operating income is $950, right? And so what you would do is you take that and subtract out that times 13% times their total assets, which they would have, of course, gotten from their balance sheet. And so that's how you do it. So 950 is their actual operating income minus their target rate times the 4.9 million. Okay. And I believe that's going to give you right at 313,000. It's on the next slide, but it's 313,000. That's the number. Okay. So let me write that for a second. So let's say we got that. So let's say we have that at 313,000. Okay. So clearly they're achieving more than their goal. They have residual. So they're beating their target. And so you might say, well, everything's good. Let's just go home and have fun. Let's just go home and play and take a nap. Well, there's other measures because remember, companies are always trying to do better. And even though we're beating the return, so if a company sees something like that, they might also say, what's our return on investment as well? And so if we wanted to do, and again, I'll just do this for snow sports. So if we said, okay, what is their ROI? Change this to this mode. I'll give you guys a second. If you remember the formula, can you calculate the ROI? I'll give you a hint. Remember, it's your operating income divided by your assets. I don't know if you guys have a calculator. I know if we were in class, I'd say go ahead and calculate that, but I'll write this out. So if we had ROI of 950 and then divide that by your assets of 4.9, that would, of course, give us our ROI. I'll go ahead and do this, man, because I don't want to switch the slides. I'll do this real quick manually on my calculation end of it. I'm doing the same thing you're doing. So I'd take the 950, divide by the 4.9. It looks like, I'm going to round mine. I'm going to say 19.4% is what I'm going to say. So let me change this. Is everybody coming up with that, about 19.4? If you got your smartphone calc. So we'll say that's our ROI. And of course, what we could do eventually is this is again for the snow sports. We could also do this for the non-snow sports. We could do the residual and the ROI. And then eventually what we could do is, lots of times at companies, what they do is they they compare their divisions. You know, what if you have a division that's not doing so well? You know, a lot of companies sometimes might eliminate a product line, or this is how you kind of reallocate resources. So let's say we were trying to figure out in this company, which division is more profitable. What do you want to, you know, do more investing and put some more money into? Is it the snow sports or the non-snow sports? And so, and that's just, these are, inner calculations. This is what companies do. You know, I often talk about, you know, you kind of missed out on all my Six Flags talk this year. In fact, I don't even think Six Flags is going to even open. You know, isn't that crazy? But every year, these theme parks, these, you know, like Six Flags, they have to come up with some sort of new gig, some new ride to get people to keep coming back, you know. And so I think this year, I think they were putting in a new pendulum ride. I forget what it was called, but I forget the amount of the investment. I'm sure it's probably, you know, a $10 million investment easily. And so they're probably sweating at places like Six Flags. If they just put in a new ride this year, that's an investment. And of course, they're not going to have any income. And so they're going to have negative returns all over the place. It's just like any other park, you know, because of this pandemic thing. But, you know, companies do these evaluations all the time to make decisions on, you know, should you expand? Should you make more investments because you want to get return? And not to mention, you guys have had business classes, you know, there's always risk. There's always inherent risk in every business. And so, you know, sometimes, of course, you try to minimize risk, but, you know, sometimes you lose. And this is going to be a case where, you know, a lot of these, you know, theme parks, a lot of the entertainment industry is going to be hurting this year because they're not going to get all that return back. I know there was, just on a side note, I remember there's a ride in, I believe it's in Cincinnati. You can look it up. It's a theme park called Kings Island. And they just did a multi-million-dollar investment into a new roller coaster. It's like, they call it like a giga coaster, where it's like it's a 300-foot drop. And they've sunk millions into this thing. And now they're not even going to have people in to the park probably the whole summer. And so that's just a cost they're going to have to eat this year. And of course they couldn't expect, you know, who knew this was going to happen. But I just, you know, just to kind of bring this up, guys, there's always risk. You just never know. You know, so there's always risk with the business. There's always something in the industry. Something could happen that could literally wipe you out. That's just part of life. All right. Okay. So again, ROI about 19.4. If you have to calculate the residual income, it's pretty simple. You just take your operating income minus some sort of target. Okay. So if I go to the next slide, let me clear these just to kind of wrap this part up. Clear this out. Where am I? I'm at 10 o'clock. Okay, we're good. All right, so notice on this one, now that I've got the calculations up, do you see where it says snow sports had 313 as residual? Well, guys, if you had done this for the non-snow sports, you would have gotten 559, right? So let's just play this. The calculation is pretty easy, but let's just look at the numbers. So snow sports has 313. Non-snow sports has 559. Here's a quick question. Which one's better? What do you think? Non-snow or snow? You'd say snow sports, right? Everybody kind of nod so I can see everybody's. I'm sorry, non-snow sports is better, right? 559. Let me make a note of this. Change my stat. 559 is more than 313. So in this case, you would say, you know, which division is more profitable? You would say the non-snow sports. Now, joking aside, why that might be important to you or me or whatever, if you were working at this company and let's say you're the accounting manager or the finance manager for non-snow sports, guess what? You probably have a better bonus this year just because your division is outperforming the other division. Now, whether you can control that or not, that's other performance measures you look at. But of course, you know, if you're in this division, you're thinking you're pretty good because you're beating the other division. You know, a lot of companies do that. They kind of, you know, not to say that you want to beat the other people, but it's competitive. And they're trying to get you to do well for the company and they'll reward you for that. But the other thing I want to mention here is they mentioned it earlier. Let me go back to a previous slide. They talked about, actually it's on the next slide. they talk about goal congruence, okay? And sometimes all these measures you're using, they don't always give you the same answer. So for example, where it says residual income enhances goal congruence, whereas ROI may or may not. And so in this case, you could go back, I don't think they did it here yet. We could go back and you could calculate ROI for snow sports and ROI for non-snow sports. And so just for this example, let's do that. So remember, before you do it, let's go back. Just remember that we said based on residual income, it looks like the non-snow sports is better, right? Because the non-snow sports says 559 and the snow sports says 313. So if you're going to say which division is performing the best based on the company's goals, you'd say non-snow sports. So I'm curious, if we go back, let's do, because this will take a minute, let's do the ROI calculation for both of these. So you got snow sports and non-snow sports. All right. So remember, you just take operating income and divide by total assets. So let me make a note just to kind of keep this simple. So if we were going to do ROI, and then we've got, I'll just put snow versus non-snow up here. And then all we got to do here, I'm just going to make a note. There's our two columns. So all you got to do is just divide. So take snow sports, you take 950, divide that by 4.9 million. You take the non-snow and take the 1,042,000 and divide that by the 7,100,000. Now, I didn't do this one ahead of time, so let me kind of get my calculation. So if I took 950 and divide that by 9, I get, again, what we say, 19.4%. I'm just going to round that off. That's what I'm going to say for snow. Now, based on what we came up with residual income, before you do it, would you expect the non-snow to have a higher ROI than snow? I would, but let's see if we get that. So if we take the 1,482,000 and divide that by the 7.1, I get it slightly higher. It's pretty close. I'm going to round mine. I get right around 20.9% roughly. It's like 20.87 something, but I'll just round it to one decimal. So we've got 19.4 versus 20.9. So actually in both cases, it looks like ROI and residual income, if we were comparing the two divisions, they would both tell you, they would both point to the non-snow sports is more profitable. Okay, just gonna say. So that's how you do it. There's no tricks to it. So you'll practice these. You got a couple in the book. Most of the problems that you're gonna come across, and it'll be the same when you get to the exam, is they're gonna give you all these numbers already. All right, they'll give you the sales, operating income, total assets. They'll give you already summarized. So you just have to know the formulas. And so it just takes a little bit of practice, but I don't think you'll have any problems with this part of the chapter. It's really more once you do the calculation, what are you looking at? Okay. All right. So having said that, you can read through the rest. I'm not just gonna read these PowerPoints to you because I know you can read them on your time. But the other big thing, and I'll probably spend some more time on you with this on Thursday, and I will show you a little bit today. It's this thing called the flexible budget. I really like this one. It's called the flexible budget. Now, the difference here, you guys did in chapter 9, you guys had what they call the master budget. And the master budget is based on what they call static numbers. You come up with one projected sales number for a quarter, for a month, and it's fixed. It's just an estimate, okay? And so the question at some point in time, you ask yourself, why do you do a budget? Well, remember, a budget is a financial plan. You're planning to earn revenue. You're planning to make money or whatever. So at some point in time, you have to evaluate. You have to do an evaluation. So what we'll do is on the flexible budget, we're going to be comparing actual. I'm going to write this here, just kind of give you a heads up on this one. If you get this part down, everything else is pretty easy. The flexible budget is we're going to take actual results and compare it to this flexible budget. Okay. This flexible budget, yes, it's a budget, but this budget, it's going to be based on, hold on, I gotta. This is my first meeting. I have to go back. One of my settings, I'm going to go back and change it after this meeting. You should be able to just automatically, if you log out, you should be able to get back in. But every time I notice something happens, I shouldn't have to readmit you. So I got to check my settings. So if something happens and you get out of it, I apologize. This is our first meeting doing this. So, I expect there could be a few hiccups along the way till I learn the whole system. I feel what works, what doesn't work with it. Tina, I got you back. I see you back now.
Yeah, sorry.
No problem. All right. So in any case, so on your flexible budget will be essentially part actual and part budget. But with the flexible budget, you're going to actually use the actual volume. I'm just going to say volume, whether you're doing a flexible budget on sales or a flexible budget on cost. But the thing that's going to happen here is we'll use the actual results of whatever we're looking at comparing to the flexible budget. The flexible budget is going to be what you think the actual should be based on actual sales. Okay. The master budget, which is the thing you did in chapter 9, all they're going to show you in this chapter is you're going to be comparing actual versus a budget, but the problem is going to be all about volume, because you're going to have sales. For example, let's say we had sales units of 10,000, and if our budgeted sales units was 9,000, then the only thing we're going to be comparing is volumes, because all your revenue, all of your cost per unit data is volume driven. So if we're not using the same base, then it's very difficult to get a good comparison in terms of where you think you should be. The flexible budget will give you that, because the flexible budget will actually use the actual volume. So let me show you what I mean by this in the next slide. So I'm just kind of using this slide here. All right, let me clear this. All right. So what I want you to see in this, I'm just going to keep this up and talk about it. So in this example, it says flexible budget performance report, and I don't want you to get nervous about these titles. All this is you're comparing actual results to your budgets. That's all you're doing. And they're doing two comparisons here. So notice this first column is your actuals. Notice it says sales volume, number of cases sold is 28,724. That's an actual number. Sales revenue, this 603,225, guys, that's an actual revenue number. Okay. And so everything in this column, I'm going to try to highlight this, would be pulled from your ledger, from your financial statements. Okay. Now, when I go to the flexible budget column, first thing I want you to look at, do you see how they're using the same number? 28,724 versus 28,724. That's your actual number. That's pulled right from your financials. So the flexible budget is incorporating actual numbers into it, which makes it more valuable. Now, here's the thing. These numbers right here, I'm going to circle these. This is for your flexible budget. So for example, do you see the 574,480, 574,480? That number would have been generated by taking your actual sales units times this $20. See the $20 over there? That $20 is a budgeted number. Your budgeted sales revenue is $20. If you take $20 and multiply that by 574,480, I'm sorry, by 28,724, that would give you 574,480. Okay. So here's what that means. I mean, I'm just focusing. Let me clear this just to kind of make sure you know what I'm talking about here. So I am just focusing on this number right now. I just want to talk about this one number. And I believe if you understand what this number means, then when I look at the rest of these with you, it's all going to fall in the same line. So this 574,480, what that means is this. So if we have actual sales of 28,724 units multiplied by a budgeted sales price per case, which is $20, that gives me $574,480. So this is what you expect. Okay. So if you drew up a budget and you said, I have budgeted sales revenue of $20 per case, and I'm going to have actual sales of 28,724, I would expect to have revenue of about 574,480. Okay, that's easy. So then my question to you then is, if I go back now and I say, okay, this actual number right here, see it? That's 603,225. Again, that's going to be pulled right from your financial statements. Notice that number is different than the 574,480. So how could that be? Well, do this. Take 603,225 and divide that by 28,724. Do that real quick. So take the 603,225, I'll do it myself. 603,225, divide that by 28,724. I get right around $21. It's not an exact number, but I get right around $21. Okay. So the question would be, well, what happened? Well, guys, inflation, right? Don't prices change all the time? If you're at the store, you go in today, of course, it's kind of hard to talk about the day's prices with all the stuff going on, but with gasoline prices being at $1.74, I just looked at the pump today. I couldn't believe it, $1.74, because the crude oil prices are going negative right now. Nobody's using oil, nobody's driving, nobody's going anywhere. But sales prices change all the time. So whatever happened in this case, again, this is for the month ended March. For whatever reason, they had planned to charge $20 per case, but they ended up charging closer to $21 for various reasons. So what would happen is if we did a flexible budget comparison just for this first line item, and again, all I'm looking at is just for sales revenue, you would just take the difference between 603,225 and 574,480, and you'd put that right there, and you would say that is a positive, a favorable variance. And all you're saying there is you made more money, or I'm sorry, you had more sales revenue than you had expected in your budget. And of course, the reason is you charge more, which for whatever reason. But if you did this comparison, the flexible budget, this is essentially what you are expecting to happen based on actual volumes. It's a pretty good budget to kind of give you an idea of where you think you should be. So if you did that, let me do this real quick. All right, so you could do that comparison. Now, you could also do that, now that I got that one, let me clear that. We could then go to the next section, and do you see how they broke this apart? Remember how we talked about cost behavior, and of course, contribution margin from your break-even chapter, but do you see how you've got a section called variable operating expenses and a section called fixed operating? That's that cost behavior stuff that essentially it's ingrained in every chapter. But for example, I want you to look at this where it says sales commissions. See where it says $1.50 per case? You've got shipping expense that says $2 per case, and then bad debts expense that says 1% of credit sales. And so these numbers, per case, percent of credit sales, those numbers represent the budget. Those are expected. That's not actual, that's the budget. So when I go over here and look at these two columns, guys, if I looked at the flexible budget column, these numbers would have been calculated using these budgeted per unit. So for example, if I wanted to get the sales commissions for flexible, I would take, I'll write this out, $1.50 and multiply that by 28,724, and that should give you the 43,086. Very simple. If I were doing the shipping, which is $2, again, that's a budgeted number per case sold, and again, multiply that by the number of cases sold, that would give you the 57,448. Okay. And then of course, the last one where it says bad debts expense to 1%, I'll write this up here. They would have taken 1% and multiplied that by, it looks like it's 574, 480. So let me erase that, hold on. So, because sometimes the screen gets kind of crazy, I'm drawing too many lines and I don't want you to get all mixed up. But let me go back. So if I'm looking at this sales commission row, okay, now at this point, remember, we're looking at cost, not revenue, we're looking at cost. So think about this. If I'm saying flexible budget on sales commissions, I'm expecting to pay my salespeople around $43,000, right? $43,086 is what I'm going to be expecting to pay my salespeople. Well, what did we actually pay our salespeople? Well, you paid them $45,960. So let's stop for a minute here. So we paid more than the flexible budget said we had expected to, okay? So your comparison there, you take the difference, and of course, in this case, you're gonna say unfavorable because you spent more than the budget. Now, I don't want you to get to think that, okay, we paid our salespeople, because remember, you gotta have salespeople to sell your product. You know, for whatever reason, you were paying your sales commissions. Maybe they got a couple bonuses, they helped the company in some way or whatever. Like that actually might be good for the company. But just in this report, you'd actually would say that's an unfavorable variance because in this case, you spent more than you had expected. That's all you're comparing. And you do that line item by line item for each of these. You could go shipping, bad debts expense. And when you're comparing those, of course, you would want, in this case, you would want these numbers to be less than these numbers to be able to say favorable, okay? And so then once you go through those line items, you say favorable or unfavorable, and then at that point, you would then investigate, you know, what's the reasons behind that? Why did you pay more sales commissions? Look, in this case, why did we have, let me clear this one. So why did we have on our shipping expense, it looked like we paid, what, $54,000, $54,578 in shipping, and we had budgeted, we thought we'd pay around $57,000. That one would be favorable. So you'd say, well, what caused that? I don't know, maybe you came up with some good contract deals with some shippers and they cut you some discounts. I don't know, but you'd still investigate it because you want to know what you're doing so well. Maybe some other divisions might want to try to do the same thing, okay? And then, of course, it's the same thing down below on your fixed cost. Notice here's your actual fixed, and then here is your flexible budget, and you'd be doing the same thing. So flexible budget was 20, and notice how usually when you get to these, and I'll get to the master budget in a minute, typically your fixed costs, because those aren't typically based on the volume, remember that's kind of like your independent cost. Your fixed costs are independent of volume in most cases. These numbers will be the same. So when we get to the master budget, your fixed costs for flexible and master will always be the same. But the actual numbers, of course, are going to be what they are. It's going to, you know, whatever your salaries are versus your office rent. But if I go to, just look at this first one, flexible budget said 20, actual says 21. Of course, that's $1,000 difference. And of course, you say unfavorable. You spent more fixed costs of salaries than you had thought that you had planned. Maybe somebody got a raise, I don't know, but you'd still want to investigate what happened, what's causing that to happen. Office rent, notice that's the same, 4,000 versus 4,000. So again, you go line item by line item, compare them, and you say favorable or unfavorable. Because remember, this is all about performance evaluation. You're trying to assess where you think you should be. You know, we had a situation years ago. I went through this stuff like this and at one of the companies I worked at, and we were always evaluating our operating income each month. And we would have actual results compared to our forecast. And you guys won't maybe or may not believe this, but we actually had a margin of error of like $100,000. So quite literally, if our, for example, I was in actually I was in a soybean division. I was I had like 7 or 8 different locations that I was managing. And each month we did a monthly close, and we would compare our actual results to our forecast. And for each one of our operating, we had this rule: as long as we were within $100,000 of forecast, we let it go. We didn't get too nervous about it. That kind of tells you how big of a company it is, a multi-billion-dollar company. But you know, it kind of brings up the point. You know, you don't want to chase down every single difference. You just don't have enough time. You want to make sure that you focus on the big differences. That's going to cause the company to have problems. But you know, if you do have time, you're going to investigate as much as you can. But you know, we had a situation where we're literally if you were within $100,000 of your forecast, we said, okay, let's watch it a couple months. Let's see if that difference comes back. And typically the difference, it was usually shipping and timing in terms of when something got shipped and when something got into somebody's ledger. So it came back to that accrual accounting issue most of the time. Sometimes not. We had a couple of issues sometimes where we were off by $1 million. We were nervous because we didn't know if we were missing something. And of course, this isn't just managerial accounting. It's all financial combined with managerial. You get kind of nervous, you know, if your division is showing something weird, you know, they're going to be looking at you saying, what's going on? All right, but this flexible budget, pretty simple. So what you do, go back. So actual will always be given to you. So whenever you do a problem and they say, you know, compare a flexible budget to some actuals, they'll give you the actuals. You'll just have to come up with this part right here. Okay. And then at some point in time, you may have to compare it. And what I was trying to show you on the slide is that the flexible budget, they use the same volume. So the actual number of units are the same. And then the numbers over here that they're showing you in this slide, these are budgeted numbers. And that's how they came up with the flexible budget. So just remember, the flexible budget is what you expect to happen using actual volume, actual sales volume. All right. That's really all there is to that one. All right. So the other one, you'll notice, since I got this one up, I'll leave this one up here since it's kind of easier to show the slide. The other one they show you is, here's your master budget. See that? And do you see how that says 25,000? And the flexible budget is using 28,724. So this column is called a volume variance, because the difference is, I'm going to draw a line right here. The difference is down to all the sales revenue and the variable cost, because these are all based on volume. These differences right here will be based essentially on volume. Okay. So whether something's favorable or unfavorable, you'll say it's favorable because of volume or it's unfavorable because of volume. So for example, if I just compared my sales, so flexible budget is 574,480. Your master budget is 500,000. So clearly that's a difference of what, 74,480. That's our variance. And of course, you're going to say unfavorable because of volume. Clearly, I'm sorry, let me go back. So you got the flexible budget of 574,480 versus the master budget. And let me go back just to kind of make a note of this. That's what you would have done back in chapter 9. Remember chapter 9, you did those budgets. I think you did like the sales budget, and you did a bunch of other production schedules. You did like direct material production and direct materials and direct labor and all those overhead. So this column right here is simply using what they call a static number. It's 25,000. That's some sort of budget. And all these numbers, again, are using these budgeted per units right there. That's how they would have arrived at these variable costs. Okay. So what happens then is when we look at any differences between the flexible budget and the master budget, any differences down to this part right here have to be driven just by volume. All right. So whether you say good or bad, I mean, yeah, we had more sales, right? We had 28,724. The master budget said 25,000. So think for a second. Are you going to be happy with that? Yeah. You want to have more sales. Okay. And so remember, just because you budget something, typically the actual results will generally always be different than the master budget. So the only thing that you can really do on this one is this first part. I'm just going to make a note. This first part right here, it's not really going to make much sense to you in terms of good or bad because it's just all volume driven differences. That's why I always would tell you that this part right here, when you compare actual to flexible, that's going to be a lot more meaningful to you as a manager, in a company, because you're using the apples to apples comparison. So let me go back, and they said there was something in a previous slide. I'm going to go back and show you. That's what they were talking about back here, where it says difference between actual revenues and expenses. It's an apples to oranges comparison because you're using different volumes. That's what they mean by that. So when you go back and do your studies and you come across that, you're like, what do they mean by that? Let me go back to this slide. This one's kind of got the numbers. Let me clear it. So if I'm in, and here's the comparison between the flexible budget and the master budget. So all these numbers right here are purely based on volume, okay? And yeah, we have more sales volume than the budgeted volume. So anytime you have more revenue than the budget, you're gonna say good. Notice how your cost, you've got sales commission, shipping, and bad. You know, of course, you're gonna incur more expenses, aren't you? If it's volume based. So even though these say bad, you say unfavorable, guys, that doesn't necessarily mean you're doing a bad job. That's the thing I think I was trying to tell you. So whenever you do the flexible budget to the master budget comparison, everything down to this part is pure volume. And so, yeah, clearly something was going on. You had more sales. Maybe this was a bad estimate. I don't know. But these numbers right here, when I compare these two, that's not really telling you too much. Yeah, I mean, if you have more sales, don't you expect to pay more sales commissions? You bet. If I got more sales, would I expect my shipping cost to be higher? Yeah. And you're seeing that. So I don't want you to get caught up when you see this as unfavorable, that you think, oh, that's bad. Well, that's only unfavorable because you've got a good variant. I mean, in fact, you would probably say, I want these to be unfavorable because that means that you got better shipments, you got more sales. All right. Now, everything down below, I don't think they had any differences. Let me highlight this on your fixed costs. All those essentially were the same. Let me clear this. And then finally, here is the actual answer to all this thing. And this is why I like this slide, because you've got this and I've already illustrated it, but you know, you can go back and just kind of, you know, take your time and make some notes and review it. But what they're again showing you here, this is the complete product right here, where you've got, again, the actuals, you've got your flexibles, and then of course, this part is where they compared the actual to the flexible, and you can see where they got favorable or unfavorable. So what I would suggest you do for practice a little bit, I mean, of course, you know, you got to get those My Accounting Lab homeworks and quizzes done. You could even take this slide, and I would even just manually go back and say, hey, look, could I figure out where I came up with these numbers? Could I actually calculate the flexible budget? So even though they're giving you the answer, so I might, on a piece of paper or some notes, I would say I would take the 28,724 and I'd multiply that by $20 to see if I can get that number. I would take, using all these numbers right over here, I would take the 28,724 and make sure that if I take that times $1.50, that I'm coming up with that 43,806. I would do that for practice. That's what I'm suggesting you would do that. Do that a few times just so you get ingrained that you know how to do a flexible budget. So I would practice that. And then I would also review, so you got these actuals versus the flexible. I would also review how they came up, just take this difference. I would think about why are they saying favorable and why are they saying unfavorable? That's another thing I want you to think about. So as we're doing this, let me again clear this. So if I looked at just this first one, I think I did this already with you, but why would they say 28,745 favorable? Because of course you had more sales revenue than you had expected. That should be an easy one. If I go to sales commissions, why are they saying unfavorable? Well, I paid 45,960 versus 43,086. I paid more than I thought I should have based on actual results. So that might be a case. You might say, well, why did we pay more sales commissions? And that's something you just have to go and talk with the supervisors, who's ever in charge of payroll. Maybe there's a good reason for it. I mean, I'm not saying it's all bad, but there might be a good reason for it, but you still want to investigate. A big one is shipping. Look at shipping. Shipping was 54,578. They had expected to be 57,448. Notice that's favorable because you spent less. Okay. Now, you might want to say, well, should I investigate that? Well, yeah, you still want to know why. I still want to know, why is my shipping cost less than what we thought they would be? Did we get a good deal from the supplier or whatever? Okay. The point is when you see these where it says favorable or unfavorable, you get study those, but I want you to ask yourself, why do you think it's favorable and why do you think it's unfavorable? Okay. I remember I tell you a story. I'd been on the job for about a year. No, maybe 1 or 2 years, maybe. I was pretty young. I mean, I was like 23, 24 years old, and I'm working in a big corporation, accounting department. And I was in charge of a few locations. And back in the day, I was always about speed. I wanted to get my stuff done fast. I just want to get it done. I wanted to show them how fast I was, right? So I would do my work, and then I would take it to my supervisor, because at the time, the role was you get your work done, you turn it in, and then of course, if there's any questions, you're there. So I would always get my work done super fast. I'd go to my manager and I'd say, okay, here you go. And then he would sit down with me and we'd go over, he has some questions, and he would always ask me this. He would always say, why? Well, why is that? And of course, I didn't do a thorough job of analyzing it. I would just say, I don't know. And then we go over a few more things. And he said, so why is this doing that? Just in general. And the point that he was trying to teach me, he was in a way, training me, mentoring me. What the point he was trying to make is like, you know what? Because see, I would turn my report into him, and then he would then have to report to his boss. That's the hierarchy. And he made a point. He said, look, he goes, I want to know, because I don't want to be in a situation where somebody asks me a question about our report or our numbers, and I don't want to say, I don't know. And so he taught me at that point, you got to be pretty thorough. You're accountable. And so you got to think of all the different scenarios when you're doing your analysis. I'm just going to make a note here, is you want to know why, because, and of course you might be in a point where they don't ask you, but you just want to be prepared. And so, but you never want to get to a point where you're in a meeting and here's Jariga and he's reporting his profits, and they say, well, why did our shipping costs go down so much? And I don't want to say, I don't know. Okay, so my point is once you do these reports, this looks like this example, this looks like it's an Excel spreadsheet, right? It looks pretty much like somebody did this on an Excel spreadsheet. This stuff, using tables, you got your spreadsheet set up. This stuff can be calculated very easy. At the end of the day, you have to do the analysis and understand the whys behind everything. And at some point in time, you're going to have to report it and use some critical thinking skills. So just keep in mind, this stuff, once you do it enough, it's actually pretty easy. But you want to get down to is you want to know, why is it doing it this way? Because I got to be accountable for it. And it's not just that. Sometimes you got to, investigate stuff and see, what's going on. Maybe, have some suggestions to do better, okay? Some of these down below, like if I go down below here, if I circle these are your fixed cost. You know, there are certain things that you can control and some things you cannot control, okay? And so just to kind of go a little bit forward past this slide, I think that's it. All right. And so notice I got this thing, underlying causes of variances, management by exception. That's where you look at just the big differences. But, you know, you want to use these things, use these numbers, use these differences to do your analysis. And that's more the thinking work that you have these days. You still got to do some of this stuff, but you also have to know how it works. Okay. And I think that was my last slide on this. So I got through that. I didn't know I'd get through all this because these slides have some, you know, pretty good examples on there for you. Okay, so let me show you. So let me go back. I know I got about 7 minutes left. Let me check something. It's probably, yeah, it logged me out. So I'm not gonna play that game. You know, we always have problems in class. I had the e-text pulled up and it kicked me out. You know, I had it ready to go and I'm like, 1022A is a good textbook problem you might want to practice. I was going to illustrate it in a minute here. It's a real short, it's on ROI and sales margin and capital turnover. But I think you probably would be better off just, you know, getting into your My Accounting Lab homeworks and, you know, start to practice those a little bit. Let me go back to the Blackboard site for a minute here for a second. So this would be my plan of attack. And then on Thursday, you guys can either, you know, send me an email or give me a heads up if there's something in particular, you know, that you want me to go back and work. I'll go back. I'll put up a handout if you need me to. I'll work anything you want me to work. But if you want to go into Chapter 10 folder, guys, you can play my PowerPoint, Notice, MP4. You can play this thing. I have already illustrated a lot of textbook exercises for you. I think that'll help you. And then lastly, you've got, again, homework illustrations in MP4. Guys, these are the same homework problems you got to turn in anyway. Now, again, I've told you this all semester. You could just play these right now and you have all the answers. But of course, you don't want to do that because you want to know how you work them. So I think a good step-by-step approach, you know, go back, you can, you know, listen to you can play my PowerPoint. You can play these textbook illustrations. I think that's probably easier than just trying to read the book. And then, of course, look at these homework illustrations. Those are the same ones you have to turn in My Accounting Lab. Okay. So what'll happen then? So after today, because I did this for I have an applied accounting class. I did this for yesterday. I didn't realize this would work so well. But what I'm doing right now is everything I'm talking about right now is being recorded. So whenever I end this meeting, I'll save this recording and then I'm going to blast it out to Blackboard. So you guys will have this as well, if you need it. I mean, you may not want, I mean, this will be like an hour and 15 minutes, but of course you can fast forward it once it's MP4 format. But what I'll do is once this meeting is over, I will go back in and I'll put it up somewhere in Blackboard. I'll probably put it, I'll probably create another link here. I'll just call it Zoom recordings, just to kind of keep it separate. And I'll label the date, and then you can go back in even after today, once it's up there, and then play that as much as you want if that's of any help to you. Okay. What I'll do then for Thursday, let me go back. So you'll notice if I go back to the announcement page, you know, before I told you that I sent out this Blackboard announcement, I'll send this out again, probably just to remind you on Wednesday. You'll use this exact same link. I set this up as a recurring meeting. So however you logged in today, you'll have this same link. I'll just kind of repost it in Blackboard. You should be able to get right back in on Thursday if you're able to come. Again, it's optional. I know it's crazy times, but if you can't make it, that's fine. I'm here. I'm trying to give you some visual, some live instruction if that helps you. I don't think you'll struggle too much with this chapter. I think this is probably one of the easier chapters. The calculations aren't over your head, I don't believe. It's the next chapter. If you notice, I'm spending, if you go back and look at the revised schedule, then I'm going to spend a couple weeks on you with it, because that's the chapter people struggle with a little bit. It's the cost variances. And so I want to give you some illustrations next time. Oh, that'll be next week, on how to do those. I think that'll help you. But this chapter, if you kind of have paid attention today and it's making sense, if you go back, and like I said, go back to that learning module, and just heads up, I took some time. It took me a while, but I got everything in MP4 format. So I think, let me know if you have any issues with opening these files, let me know. But you should have an easier time opening them now than you did before. But please play those. And then of course, let me know if you have any questions. I tried to control this today, because Zoom, there were some issues with Zoom, I think in a couple of the other states I heard where, some hackers hacked in and they did some weird stuff online. So the way I set the settings on this one is I'm the only one that can share the screen. I just did that just to protect everybody, just in case somebody were trying to hack, not that somebody's going to try to get in here and listen to our meeting, but it's just for a lot of the controls and security that the college wants us to have. I think Zoom works pretty cool. I like it better than the Blackboard Collaborate that they have, but I like this Zoom. I hope you're able to view this. I hope it's helping you a little bit or some. Let me know. It's the best we can do at this point. I know what's today, April 21st. So we got about 2-3 weeks left anyway, 3-4 weeks. We'll just kind of make the most of it. By the way, the exam scores, I think most you're probably pretty happy if you go back and check your exam scores. After I did a little bit of a bump on it, I think most you might be okay with your exam grade on exam 2. You probably think, yeah, I wish I could have done that for exam 1. So that's where we're at. I got about a minute left. I'm not going to keep you over because I know you got other stuff going on. Email me if you have any questions. This whole thing has been recorded. I'm going to put this out on Blackboard if you want to go back and play it. And of course, you've got the learning modules. All right. So I hope that's helping. It looks like looks like you can hear me, right? Everything's going okay. You can kind of, any technical issues? Is my voice coming across okay on your computers? Yeah, it's interesting. When I went through the training on this, they said to get a headset because you get better audio. And I did a couple test runs where I recorded myself. I felt like I could hear myself just fine. So I didn't want to go out and spend money because, the college isn't going to spend money for us on that. But all right, so I'm right about that 1044, 1045. Email me if you have any questions. Is this something, do you guys like this? Is this helping a little bit? I wish I had this about a week or two ago. I was getting some stuff worked out, but I'll do this for the rest of the semester, Tuesday, Thursday. And if you can join, that's great. If you can't, nothing's going to be counted against you. But just remember, if you can't join, if you can't come, I'll still record whatever we're doing, and you can still go back in and play whatever we do on Thursday if you can't make Thursdays. So I think that's kind of a cool feature. So, all right. So I'm going to wrap it up. All right. Any issues? Okay. I know it's weird on online settings, different. All right. So I'm going to go ahead. Oh, hold on a second. I just saw my chat feature. Sorry. It just started coming up. Did you guys just do that? It seemed like it's been a while ago. All right. Well, I'll go back in, guys, and I'll check my settings. And I may have set something up where if you tried to chat with somebody, were you able to connect? Were you able to chat with each other a little bit to say hi? Did anybody try that? Did it work or not work?
In chat?
Yeah.
Yeah, it's working.
Your chat works? Okay.
Mm-hmm.
I'll check the settings to make sure that if you wanted to even send me a chat when I'm doing this, if there's a specific question or something you want me to go back over, just let me know. So if you come Thursday, and you think of something in particular you want me to focus on, let me know and I'll do it. If not, what I'll do is there's a couple more problems I'll illustrate with you, and literally whatever else you can think of, if you have something, let me know and I'll be glad to illustrate it for you. All right. Cool. All right. We're out. It's a little bit past the hour. I don't want to keep you too late. So, all righty. So I'm gonna go ahead and end it. This will get recorded, and then I hope to see you guys back on Thursday. All right. Cool.
See you Thursday.
All right.
Thank you.